All right, let's dive right in. There's a new tax rule in India that's causing a lot of headaches for businesses, and it's a weird one. It means that just paying a bill late could do more than just upset your supplier. It could actually make your tax bill go up.
I know what you're thinking. That sounds completely backward, doesn't it? How can paying for something your business legitimately needs end up costing you more in taxes? Well, believe it or not, a brand new rule makes this exact scenario very, very real. Let's break down how.
So this isn't something on the horizon, it's here now. Starting with the financial year that ended in March 2024, there's a new provision in the Income Tax Act, and it's a major curveball. It basically creates a direct link between your ability to deduct an expense and how fast you pay your suppliers.
So what's the culprit? Well, it all comes down to a small but pretty powerful new clause, Section 43B(h). You know, it was actually designed with a good intention, to help small businesses get their money on time. But its effect on everyone else is what we need to look at. This new rule has a very specific target. It's all about the payments you make to micro and small businesses. And the rule itself is brutally simple. If you don't pay them within the legal time limit, you lose the right to claim that payment as a tax deduction for that year. So here's the critical piece you have to understand. It doesn't matter that you've got the invoice, that you've logged it in your accounting system. None of that matters to the taxman. If the actual payment to your micro or small supplier goes out late, that deduction is gone for the year. Now, you can claim it later in the year you finally pay, but that timing shift can throw a huge wrench in your cash flow and tax planning.
And that, of course, brings us to the first, most practical question every single business has to ask right now. Okay, so which of my suppliers are we even talking about? The law's super specific on this, so let's get into the details.
Okay, so the government has laid out some very clear lines in the sand here. To be a micro enterprise, a business has to have less than 1 crore in plant and machinery and less than 5 crore in turnover. For small, it's less than 10 crore in investment and less than 50 crore in turnover. And here's a key piece of information. Notice who's missing? Medium enterprises. They are not covered. So if your supplier is medium, you can breathe a little easier. So how can you be 100% sure? You can't just guess by looking at their website or office. Nope. There is only one official way. You have to ask them for their UDIAM registration certificate. That piece of paper is the golden ticket. It will clearly state micro or small. If they don't have one, or if it says medium, then congratulations, this rule doesn't apply to your payments to them. Okay, you've figured out who your micro and small suppliers are. Great. Now we get to the most important part, the deadline. A very, very strict payment clock is now ticking, and it probably overrides whatever payment terms you'd think you have. Let's see how it works. This is the absolute heart of the matter. It all boils down to 2 scenarios. Scenario 1, you have no written agreement with the supplier. The law is absolute. You must pay within 15 days. Scenario 2, you do have a written agreement. In that case, you can follow your agreement. But, and this is a huge but, it cannot be for more than 45 days. So if your contract says 60 or 90 days, for tax purposes, forget it. The real deadline is 45. Period.
Let's just zoom in on that 15-day rule for a second because it's the default and it can really trip people up. The clock starts ticking from the day of acceptance, and that is not the invoice date. It's the day your company officially says, yep, these goods are fine or this service was delivered correctly. So if a shipment arrives on a Monday but your team doesn't approve it until Wednesday, that 15-day clock starts on Wednesday. Payment has to be out the door before day 16. So you know the vendor, you know the deadline. But what happens if you're late? What's the actual damage? This is where this new rule really shows its teeth. Just look at this table. It makes the cost crystal clear. In both cases, the goods are accepted on February 10th. With a 45-day agreement, the due date is March 27th. Now look at the top row. Payment goes out on March 25th, on time, all good. Your deduction is allowed. But now, look at the bottom row. The payment is made on April 10th. It's only a couple of weeks late, but here's the killer detail. It's after the March 31st financial year end. And boom, the result? That expense is completely disallowed for that tax year. Your profit looks bigger than it was, and your tax bill goes up. And if you want it in black and white, here it is. This is not an interpretation.
This is the law itself making a direct connection. If you fail to pay on time, you trigger the penalty. There's no gray area, no wiggle room. It's a straight line from cause to effect.
Okay, I know that all sounds a bit stressful, but here's the good news. Avoiding this tax trap is 100% within your control. You just need a clear, solid process. So let's build your action plan.
Here are 5 concrete steps you can take right now. First, identify. Go through your entire vendor list and flag everyone who's a potential MSME. Second, verify. Don't just guess. Get that UTM certificate. It's your only proof. Third, review. Look at all your written contracts. Anything with a payment term over 45 days is basically invalid now for tax purposes. Fourth, systematize. Get your accounting software on your side. Make it automatically flag these invoices and their real due dates. And finally, number 5, prioritize. These invoices need to be VIPs. They have to jump to the front of the payment queue.
And this quote right here, it just sums up the whole strategy behind the law. The government isn't just asking nicely anymore. They've built a painful tax disincentive to force a change in behavior. What used to be considered good business manners, paying your small suppliers quickly, is now a hard and fast rule for your own financial health.
So that leaves us with one final thought. Yes, this rule forces you to change, but could you actually turn it into an advantage? Think about it. If you build super efficient, fast payment systems, you not only stay compliant, but you could become the preferred client for all the best small businesses out there. So the question is, how will you turn this challenge into your competitive edge? Thanks for watching.